TCS surges more than 2.5% after the first quarter revenue and margin beat estimates. The management tells CNBC-TV18 that they maintain the FY25 will be better than FY24. Other names like Wipro and Infosys also surge in trade.
Oil India rallies over 7% after brokerage firm Morgan Stanley raises its target on the stock to 663 rupees from around 496 rupees earlier, while maintaining an overweight rating.
HPL Electric continues to surge. The stock is up over 40% now in 2 sessions after it won a 2,100 crore rupee order for smart meters yesterday.
IREDA shares crossed 300 rupees mark ahead of its first quarter numbers today. The FPIs have double stake in the company in June quarter. The stock has rallied over 180% in 2024 alone.
And Jio Financial also trades with gains after the Reserve Bank of India approved its application to convert to a core investment company from an NBFC.
Hello and welcome to Chartbusters. I'm Nigel. With me is Hormuz. As we speak, it's a good showing actually on a Friday morning. The overnight Q is a little bit mixed, but our markets, in fact, are still holding with gains of around 55 points. What remains elusive is the 24,450 mark, at least as of now. The Nifty Bank, well, it was up close to around 150, 180 points at the high of the day, but that's flattened out a little bit, and that's been a relative underperformer. But TCS, that's the star of the day, up 2%. And it's firing up some of those mid-cap stocks as well, which are doing very well, Hormuz.
IT is leading the pack in today's session, right? It's lending that much-needed support and some much-needed direction the Nifty needs since this week has been pretty directionless for the benchmark index. The Nifty IT now up over at the 38,000 mark. Now it's very close to its all-time high levels, which is around about 39,400, which it had made in March of 2022. So nearing the all-time high levels is the Nifty IT index, and as Nigel was highlighting, TCS and of course the top gainers on the Nifty are the IT stocks, be it TCS, Infosys, Wipro, Tech Mahindra, all of them seeing good gains. But the underperformer today is HCL Tech. That's not seeing as much of a gain as the other IT stocks are seeing in today's session. The HCL Tech reports numbers as well later this evening, so not so much on HCL Tech, but it's picked up in the last few minutes. 0.7% higher now is HCL Tech, but the others, the broader markets, are continuing to do well, especially the small caps.
Well, that's right. You just take a look at a few of these names. First Source, the stock is now up close to around 5% as we speak. So big up move is what we're seeing on First Post. You have Coforge as well. That's now up close to around 3.5% approximately. So that's moved to the high point of the day. On the flip side, a few of these stocks have flattened out. Oil India actually was up close to 7%. Now it's up around 4.5%. There was yesterday some big pre-buying. We saw a massive delivery-based buying on that one as well. So maybe, in fact, some part of profit taking is what you're seeing on that name. GNFC as well in early morning trade was doing quite well. That as well has slipped a little bit. On the flip side, a few more of these, just to highlight a few of these names that are doing rather well in today's trading session. HPL Electric, what do you say about that one, Hormuz? Just moving from strength to strength. And these have been some of the big winners in the week. Inox Wind as well, now locked up close to around 10%.
No, HPL Electric also, because the quantum of the order that they had won, it was 2,100 crores, almost 60% of its market cap.
Yes.
So it was a big order that HPL Electric won. It was up 20% in the circuit yesterday and up another 15% today. So very strong show from HPL Electric. But there is some management conversations lined up as well on the show. But before that, we'll pull up IREDA as well. That stock has seen a very sharp surge as well, and that stock has now crossed the mark of 300. But we'll get to IREDA in just a bit. But Anand Rathi Wealth now reported a strong set of first quarter numbers. They achieved 96% of its AUM guidance for FY25 in the first quarter itself. Now assets under management also grew 16% quarter on quarter. To discuss more on this and the road ahead, Feroz Aziz, the Deputy CEO of Anand Rathi Wealth, is now joining in to discuss the numbers in detail. Feroz, good morning. Thanks a lot for joining in. Well, let's start off with the AUM number itself, right? You're guided for your AUM figure. You've already achieved 96% of that in the first quarter itself. We look to revisit that number now for the full year, and how much of that has come from this resultant market recovery that we have seen in the last month and a half?
Good morning. Like you rightly pointed out, we've met with God's grace a lot of 96% of the guidance for the year with respect to AUM. Point one, a large portion of that which is 3,366 odd crores, comes from net flows which is up about 173% vis-a-vis the same quarter last year. We had collected about 1,200 odd crores in the same June quarter in FY24. We've collected almost 3 times that, or 3,300 crores, which is 173% to be more precise. So that's one variable. Second, because we collect long-term monies only, we have a very strong gatekeeping. We don't bring liquid monies of corporates or large treasuries. We focus on intergenerational wealth. So the equity proportions are larger. Unlike most other wealth management outfits, you see 54% of our total assets, which we report, are in equity mutual fund with our ARN, which is going to be very clearly standing out in the industry. So point I'm trying to make is when the economy does well, and if your proportions are going to be long-term monies invested in equity, the mark-to-markets are also greater. The mutual fund selection, which we do large, deep selections. So that gave an alpha over the Nifty as well. So I think 3,300 crores, the large component in terms of 173% increase in the net flow, which is what I think we have to thank each of our client and prospects to give us larger wallet share, is one of the reasons.
All right. Hi, Feroz. Good morning and good to see you in. Looking younger, I think looks like these results are rubbing off onto the look as well. Looking younger every time we speak. So kudos on the numbers. You know, going by the AUM numbers that you put out, don't you think it makes sense to revise both the revenue and the PAT estimates that you put out at the start of the year? Because it's been a very, very strong start. What would the revised numbers look like?
Nigel, thank you for the great comment. If I have to be worthy of sharing a screen with you, I better look young, at least as half as young as you are. That's what makes me worthy of sharing a screen with a handsome hunk like you. So that's my point one, and I'd say most of the female viewership would have a lot of motivation to see you. And your screens. Coming to the more serious subject of our results, we personally think that under-commit, over-deliver is something which our professional guru, who is Rakesh Rawal, the CEO of the company, who's been the CEO for the last 17 odd years, has always told us, be it a client commitment, be it an internal commitment, be a shareholder commitment, whomever you are speaking to, pran jaye but vachan na jaye. That's the kind of thought process. With that kind of thought process in the DNA, at least we attempt to not revise it upwards at this stage, because mark-to-market ups and downs happen. Net flows is on our control, and that's where we are focusing to try and bring 800,000 crores every single month. And we have a very simple business model. We don't bring assets which don't earn us 1%. We want to earn our clients 13 to 15% compounded return, and we want to earn ourselves 1.1%. We filter all the assets at the entry stage. So if we bring 1,000 crores every month or 800 crores every month of fresh flows, anybody will be able to very easily extrapolate what will be my PAT in the next 5 years, giving a mark-to-market of 10-12%, which is a God's gift to our business. So to answer your pointed question, no revision, at least not 9 months before the year end. But we'll always strive to do better than what we speak to credible channels like you, to make sure that you're not over-committing and under-delivering ever.
Okay, let's focus on a couple of aspects then. Structured products, you know, it's at around, I think, 24-25% of the mix. The guidance, I think, was to get it to around 30 to 35%. By when does that happen?
Nigel, see, most of our clients, we recommend 25 to 35%. So yes, we were at 29%. Equity mutual funds grew substantively because our model portfolio gave 16% alpha over Nifty last year, and has, as we speak in this quarter, which has gone by, it has generated an alpha of 6.3% on Nifty. So the mark-to-market on equity mutual fund is higher. That's why you see 48% of equity mutual fund has moved to 54%, in spite of the assets growing from 59 to 69,000 crores. So point one, coming to your pointed question, realignment is something which we are going to focus on. It's always very important to realign from the asset which has performed in the rearview mirror to an asset which brings in stability. So I can't tell you a date, but definitely realignment is the mantra. So that proportion of 24% into structured products will move towards 30 by the year end, give or take. Please don't hold me to that commitment.
Indeed, but Feroz, you had earlier mentioned that your relationship manager guidance, you look to add around 40 to 50 per year, and you have already recruited around 28, if I'm reading it correctly, this quarter itself. Now, what's the road ahead on that? And employee expense for you as a percentage of revenue has also inched higher. Now, as business grows, would you look to increase the number of recruitments as well? And what's your sense on the employee expense as well as a percentage of revenue?
So 2 points. I think in terms of number of relationship managers, we have a very important thought process, which we have tried to hold on to for the last couple of decades, is to not get carried away and expand so much that your DNA, your culture, your social fabric, your delivery in the marketplace gets diluted. So we are now never constrained by capital or the capability to spend. We are generally constrained by, are we able to find enough people who match our thought process? So coming to the point, we will always try and make sure that we train our people internally. So 80% of our latest recruitments are internally trained account managers promoted to relationship managers. Coming to your pointed question, the guidance in terms of the number of people increase will also not be revisited. If we find good people in good locations or internally, then we hire, because just spending money to recruit people is something which is not our forte. And what you would definitely see, I think it's one of the first few times in the Indian financial services history that we have seen 1 year of zero attrition in Anand Rathi Wealth Limited. Regret relationship managers. This quarter is also zero attrition. So bring in no leaking bucket from a client perspective, from an employee standpoint. So you do great gatekeeping is when you can deliver 0% for one full financial year, which I think in financial services industry should be first few times this would have ever happened.
Indeed. Feroz, always a pleasure speaking to you. Thanks a lot for joining in. Wish you good luck for the quarters ahead and for the full FY25 as well. Feroz Aziz there from Anand Rathi Wealth on the road ahead for the company. 0.7% higher, but the stock has moved up significantly. 550 was the IPO price, Nigel. 4170 now is the stock. So it's been a great performer for investors as well. Time for a short break here on Chartbusters. When we return, we'll be joined by Manas Jaiswal to discuss market technicals. Stay tuned. Back on the other side.
Welcome back. The broader markets actually are calling for your attention today. EIL continues to move higher. For this month, it's up 20%. Last couple of days, I think almost the entire 20% move has come about. The stock is 300 rupees now. I think around 12 months or so ago, the stock was around 100 rupees. So that's the kind of move that you've seen out there. IRFC is now moved to the high point of the day. And IFCI is now up close to 10%. So some of these stocks, debatable whether or not they should be at these levels. But for the time being, they're moving with solid momentum, moving to the high point of the day. Well, let's get in Manas Jaiswal, who joins us. Hi, Manas. Good morning and good to see you in. It's a good start. The problem is we're unable to build on from here. If you were a bear, you'll say that I still got that cover. That 24,450 mark is still that line in the sand which I can defend. What would your trade be?
Good morning, Nigel. So Nifty is consolidating and it is consolidating just above 20 moving average. I think the undertone is bullish. I still believe that Nifty has potential to test 24,750. So even from current levels, you can see almost 300 to 350 points rally. So I think positionally you can take a chance, take a long position here at current levels, keep your stop loss below 24,250 and target would be 24,750 on Nifty. However, on Bank Nifty, I think just keep a close eye on Bank Nifty. If it crosses 52,500, then you can see almost 1,000 points rally in Bank Nifty. So keep a close eye on Bank Nifty. If it breaks 52,500, take a long position. Stop loss should be around 52,000.
Well, if you believe, Manas, that the Nifty could reach 24,750, firstly, would you think this would be possible in the July series itself? And couple that up with your stock recommendations as well.
So yes, possibility is very high. I think more because the IT index has given a fresh breakout, and I believe that Nifty IT index can give around 1,000 points rally from here. So you can definitely expect 24,750 in this expiry on Nifty. The stock specific, first one is a buy call on TCS because stock has given a fresh breakout on the charts. It is making higher tops and higher bottoms, so take a long position here. Stop loss should be around 4020. Target would be around 4150. And second is a buy call on Axis Bank because here also you can see a fresh breakout on the charts. I think this outperformance will continue and Axis Bank can test 1365 soon. So take a long position here also. Keep your stop loss below 1304.
All right, Manas, thanks a lot for joining in, sharing with us your views on the index and specific stocks as well. Manas Jaiswal there, expecting the Nifty to hit 24,750 on the upside, betting on IT stocks as we speak. But let's shift focus now to our special segment where we get you a few ideas for profit from Money Control Pro. Bharat Gianani of moneycontrol.com is now joining in to talk to us about a stock that he's tracking closely. Bharat, take it away.
Today's ideas will be Canara Bank Retail India Limited. The demand, which was under pressure over the past 4 to 5 quarters, has been witnessing improvement. The company indicated that it expects a positive same-store sales growth of 6 to 7% in the current quarter. The demand recovery has been broad-based and is being witnessed in the both urban and rural areas. The company would continue aggressive store expansion and aims to open about 85 to 90 new stores every fiscal. The company would strengthen presence in the north and the west market and also tap new markets in the central and the east India. The company is also expecting a healthy same-store sales growth of 6 to 7% on an annual basis. New product launches and increased focus on the women and children wear would drive the same-store sales growth. Also, price hikes and improved sales of accessories such as socks, handkerchiefs, and footwear would also drive the same-store sales growth. The company is also targeting to ramp up the online business and expects a share of 100 crore from the online business over the next 2 to 3 years. Canara Bank Retail India is a premium quality apparel player with a positioning in the mid-premium space. The company has a strong balance sheet and robust return ratios. At the current market price, the stock is trading at a PE of 22 times FY26 earnings projections. Investors can add the stock in the pool.
Got that. Thanks, Bharat, for that. Well, let's get to an exclusive then. Sources are telling CNBC-TV18 that the city gas distributors are seeking parity between taxes on natural gas and those on LPG and electric vehicles in order to be price competitive. Sapna joins us to fill us in with what all she's picking up. Sapna?
Yeah, hi Nigel. So this is basically a big pain point for the CGD players, so to speak. So what they're demanding is a waiving or a standardization of the high VAT rates on both the gas products, CNG and PNG. They are saying very clearly the VAT rates do lead to cascading, and even in terms of encouraging existing LPG consumers into PNG. I mean, basically, convenience is not just a factor. Costing is also a major factor. They're citing the example of Uttar Pradesh, for example, like it levies 10% VAT on CNG purchase without ITC. And on top of that, they have a 12.5% on the sales as well. Similarly, if you look at it in terms of comparison with EVs and LPG, which are under the GST regime, well, there it's 5%, whereas you have an excise, a central excise of 14% on CNG and a VAT of 5 to 10% for CNG and PNG. So, we're talking of tax rates between 22 to 23% for CNG and PNG in comparison to 5% LPG. And of course, EV is also a big pain point for this CV industry. So 14% excise on CNG needs to be waived, reduced to a minimum. They have also worked out the calculations, and this is of course based in terms of the FY23 numbers. So we just need to be mindful of that. So out of a 270,000 crores is what the central government collects in terms of petroleum taxes. Out of that, CNG would have, if it's waived completely, it's an 8,000 crore state for the government. The number can be slightly higher in the current year. But if there's a cut, then obviously, it will be much lower than that, than this 8,000 number that we're talking about. Last but not the least, they also want the GST on CNG vehicles is still at 28% at par with petrol and diesel. Again, comparison with EV, which is under 5%. So they want that to be brought at parity with EVs. Plus, waive road tax, registration charges of CNG vehicles in line with EV. Last but not the least, in terms of the LPG versus PNG debate, create LPG-free zones where PNG network is available. So this is a big pain point. And, going forward, Nigel, you have all kinds of fuels in the market. So you have IT, you have CGD, you are talking of hydrogen, and then, you're talking of EVs. So there is a big shake-up in the industry, which is ongoing, not very visible right now, but to become more visible over the next few years.
All right, Sapna, thanks a lot for that exclusive update there. Sapna Das with that exclusive news break. Time for a short break. More on the markets and specific stocks on the other side. Stay tuned. Back with us here on Chartbusters, and fertilizer maker UPL is in focus after German chemical maker BASF said that it will discontinue the manufacturing of glufosinate ammonium in Germany by the end of 2025. Sonal is here with more. Sonal, how is this likely to affect UPL?
Well, first to give you the perspective, BASF is one of the biggest chemical manufacturers in the world, and if they say they are facing competition, it means there are headwinds in the industry. BASF has discontinued glufosinate ammonium in Germany by 2024-2025. They'll be shutting their factories across the board wherever they have for this particular agrochemical as well. They plan to cease production of the active ingredient due to economic reasons and rising energy costs in Europe as well. Now remember, glufosinate ammonium is a key component of their portfolio in terms of herbicides as well, and this was a big contributor in terms of revenues as well. BASF's GA production is increasingly affected by rising competition from generic manufacturers, alternative technologies as well high energy and raw material costs is what the management says. Now remember, UPL also produces the same chemical. It can go in two ways. One, it would mean that supply will cut down globally, it would mean higher prices, and would also mean that UPL will be able to cater to that bigger market. Second, it could also mean that this competition could also hurt UPL. So we'll have to see how UPL can go ahead and make the most of this opportunity. But considering that BASF, one of the biggest chemical manufacturers, is talking about headwinds in the industry, that says a lot about what's happening in Europe and energy costs as well.
Okay, all right. Thanks a lot for that, Sonal. By the way, take a look at the markets. Boom, boom, boom. We're moved to the high point of the day. Tech Mahindra, HCL Tech, LTI Mindtree, they are the ones that are firing away. Big up move is what we're seeing. And Reliance Industries as well has recovered from the low point of the day. So I think just pull up Reliance Industries and the Nifty IT index. Both of them have spurted up. Explains why. Just take a look at that. Big boy Reliance Industries coming to the party. Explains why the Nifty now is at the high point of the day, on the verge. We are at a fresh all-time high, by the way, on the Nifty as we speak. 24,470 is where we are at. It appears today we have the ingredients of a bit of a breakout day. So let's see how it goes from here. For the time being, we'll wrap up on Chartbusters. You stay with us. Trading Hour comes up next.